Listen, if you're worried about interest rates increasing, you might be behind the ball. A lot of the smart investors, they have shifted their focus to potential rate cuts in 2023 and early 2024. So this is a historical study looking at how stocks perform before rates go down, during rate cut regimes, and also after rates make their trough. So if you're a bear, you're going to want to see this. If you're a bull, you're definitely going to want to see this. All right, let's get into the data. So here are the Fed funds futures. Currently, when I ran this study, they were sitting at 5.13%. You can notice out to January that they are expecting rates to drop to 4.39%. So that basically is telling you that the smart investors, they are expecting some easing in the months ahead. Now you got to ask yourself, is this bullish for stocks? So the historical study is going to look at prior times when rates began to fall. Let's go ahead and zero in on those areas. So back to 1981, and I'm looking at the 3-month T-bill yields, you've got 7 distinct periods in yellow where rates fell. Now here's where we are today. You can see that steep climb that happened in 2022. But some of these rate pullbacks, they're going to be familiar to us, right? You've got 2000, that's the dot-com. You've got 07, 08, that's the GFC. And then we've got the COVID, some pretty critical areas where rates actually fell. So the million-dollar question is wondering, how does the S&P 500 perform before rates fall? And so for this study, I looked at our 7 periods, and then I ran the return to the S&P 500 6 months before the 3-month Treasury bill yield started to fall. And you can see the average return is a modest 1.03% for the S&P 500. So basically, heading into rates declining, stocks tend to struggle. Not always, but they tend to. This is the period that we are in now. So then the billion-dollar question, how does the S&P 500 return during falling 3-month T-bill rates? Okay, so we're going to look at our 7 periods. I've got the rate peak, I've got the rate trough, and the rate of change. So this is literally the area. This is when rates are falling. This is a big chunky decline. But over here, this is the S&P 500 return during these periods. Now, 5 out of 7 instances, stocks were red on average. However, you had a couple of, big green periods, 84, also 1990s. But the average return for the S&P 500 is still relatively flat, but it's heavily skewed to the last 3 big recessions that we had, right? COVID, global financial crisis, and obviously the dot-com crash of 2000. So those would be considered hard landing scenarios. I am not in that camp. You've got a strong consumer. I think stocks are going to be just fine. But now for the trillion-dollar question, this is when you want to take the bear suits off. How do stocks perform once rates trough? Get this, and this is the most important piece of this study. We have our 7 periods. Look at the S&P 500 return 1 year post-rate trough. In all instances, stocks are up double digits. The average return for the S&P 500 is positive 27% a year later. These are incredible numbers, and this is why I think you've got to be very careful being uber bearish right now. Yes, rates may decline, stocks may struggle, but once we get to that period where rates trough out, okay, the Fed is going to light a fire in the economy. It is going to send stocks surging. We have been really hyping on big time tech stocks. That is where the big money is flowing. And you know what? If you're worried about a sputtering economy, those are going to be the areas that are going to outperform. I hope you guys enjoyed this study. It's super unique to Map Signals. Make sure to like and share. It really would help us out. I will see you guys next time.